Hey, I'm Aagam, founder of Finance As You Grow. I'm a mortgage broker and I help people structure their loans the right way. Today I'm breaking down something that confuses a lot of first home buyers and even experienced investors. Offset accounts and the different type of loan repayments. By the end of this video, you'll understand exactly what they are, how they work, and when to use each one. Let's start simple. An offset account is just a transaction account like your everyday spending account that's linked to your home loan. The important part though, the money sitting in an offset account reduces the amount of interest that you're charged on your loan. Let me give you an example. Say you have a $500,000 home loan and you've got $20,000 sitting in your offset account. Instead of being charged interest on the full $500,000, you're only being charged interest on $480,000. However, that's only for the period that $20,000 sits in your offset account, as the interest is calculated daily. If you're on principal and interest repayments, your repayment is going to stay the same. However, if your repayment type is interest only, that's when your repayment actually reduces, because all you're paying is interest as part of your repayment, and the more money you have in your offset will reduce the interest, and therefore your repayment will reduce. Now, the best part of an offset account is you have full access to your $20,000, which is sitting in your offset account, because it's simply just a transaction account. Whereas if your money was in redraw, that money is sitting inside the loan account and you have to transfer it out into a transaction account, and then you can use that money. Whereas an offset account is as good as a transaction account, and you can actually get a debit card against it. Now, let's talk about the different ways you can structure your loan repayments. There are two main repayment types: principal and interest, and interest-only repayments. Each one works differently and suits different situations. Principal and interest means every month you're paying back both the amount that you borrowed, which is called the principal, and the interest that the bank charges you combined. So this means your debt is reducing over time, because with every repayment, you're paying down a small part of your principal, meaning the total amount that you borrowed. This is the most common type of repayment for most first home buyers or owner occupiers, because you want to pay down that loan and reduce your long-term interest. Think of it like this: every payment you make is chipping away at the actual loan amount, and therefore you owe less and less every month. And what you'll find is at the start of your loan term, when you're paying principal and interest repayments, your principal portion will be less than the interest repayment quite significantly. But what you'll find is over time, your principal starts increasing and your interest starts reducing, and you start paying more principal than you start paying interest at a certain period. Interest-only repayments, on the other hand, or we also call it IO, is quite different. With an interest-only loan, you're repaying only the interest for a set period. Usually you have this flexibility of setting this set period. It can be anywhere between 1 year to sometimes even 15 years. Now, what this means is that your loan balance is not going down unless you voluntarily make a repayment. With every repayment that happens, it is only the interest portion that you are paying. So if you're paying 6% interest rate, it's simply 6% times the loan amount divided by 12, and that's your monthly repayment, simply put. So why would anyone choose this? Why are we not paying down the debt? If your main goal is cash flow, interest only is perfect, because there is no principal being paid, and therefore your monthly repayment is lower. And this is quite common for investment properties, because this way you're not paying down an investment property, and because you're not paying down the investment property, your interest deduction is staying consistent. But here's what you need to know. Once your interest only period, which we decide at the time of applying for the loan, ends, your repayments will revert back to principal and interest repayments, which will mean you'll start paying off principal. However, you can re-extend this interest-only period by refinancing the loan with the same lender, or refinancing it to a different lender and extending that interest-only period again. But this means that you will need to provide your documents again and prove your serviceability, meaning that you can borrow again. Whereas on the other hand, a fixed rate is basically you guaranteeing the interest rate that you will be on for a set period of time. It can be anywhere up to 1 to 5 years with most banks. Now, this rate is going to be set by the bank that is providing it. And what that means is if the RBA was to increase or decrease the rate, it will not impact your interest rate for the period that you have chosen to have the fixed rate. This can be beneficial in times where rates might be increasing and you want to lock in a rate today, which will guarantee you for the period that you choose it for. However, the downside is that if the RBA reduce the rate and your rate is fixed at a certain rate, then your rate will not reduce for the period that you have fixed it. The other downside can be most banks don't provide offset accounts for fixed rate loans. And in this case, the recommendation would be to split your loan and fix a portion of it and keep another portion variable against which you can offset your loan. What is the maximum period that you can fix your loan for? Generally speaking, it's up to anywhere between 1 year to 5 years. If you'd like to see whether fixed rates or variable rates would apply to your specific situation, book a call with us in the link in the bio.